A strong dollar should feel like a sign of health, but sometimes the cleanest number on the screen is the one hiding the infection. It rises while factories slow, while debts get heavier, while other currencies bend under pressure. It shines brightest when the rest of the world is scrambling for air. And that is why a strong dollar can be less like a trophy and more like a warning flare. So if you want the part of the market story that usually arrives before the headlines do, stay close to this channel, because the move that looks safest at first can become the move that changes everything later. When Ray Dalio says the dollar looks strong and that is the trap, he is pointing at a pattern that has fooled people many times. What looks powerful on the surface can be feeding on weakness underneath. Picture a family driving through town on a bright day, seeing the local bank sign, the gas station sign, the grocery sign, all still lit up. Nothing looks broken from the road. Then they turn onto the industrial side of town, and half the loading docks are quiet. The town still has power, but the engines that made it feel alive are slowing down. That is what dollar strength can look like in the economy. The dollar can rise because money is running toward safety, not because the system is becoming healthier. It can climb because something else is under stress first. And when stress starts somewhere else, it rarely stays there. Most people hear that the dollar is strong and assume that must be good for America. It sounds like a compliment. It sounds like the world voting for the United States. But markets do not vote with love. They vote with fear, survival, and the need to find the deepest pool when the weather turns bad. That matters far beyond Wall Street. A strong dollar affects jobs, borrowing costs, retirement accounts, credit cards, rent pressure, and how long a paycheck lasts. It can hit a small business owner ordering parts from overseas, a retiree living on savings, and a worker whose company suddenly freezes hiring. It changes the air normal people breathe, even if they never look at a currency chart. The trap begins with a simple misunderstanding. People think strength always means stability. In markets, that is not always true. Sometimes a thing gets stronger because everyone needs it at once. And when everyone needs the same thing at once, that usually means something is wrong somewhere else. The dollar sits at the center of global finance. A huge amount of world trade is priced in dollars. A huge amount of debt outside the United States is also borrowed in dollars. That means when the dollar gets more expensive, the burden of paying that debt gets heavier for countries, companies, and banks all over the world. Think of a shop owner in another country who borrowed in dollars because dollar loans were cheap and easy a few years ago. His business earns money in his local currency. If his currency falls while the dollar rises, his debt does not just stay the same. It becomes harder to carry, even if he did nothing reckless at all. Now widen that picture. Replace the shop owner with a property developer, a shipping company, a government ministry, or a pension fund. The same pressure applies. When the dollar strengthens fast, it tightens the financial world like a rope being pulled from the center. The people closest to the strain feel it first, but the shock travels outward. If you watch this channel for the moments when one market move changes the meaning of everything around it, this is one of those moments. A strong dollar is never just about tourists getting a better exchange rate or investors feeling clever. It can be a signal that the global plumbing is under pressure, and plumbing problems only look boring until the ceiling starts leaking. Here is where the story gets more uncomfortable. The United States benefits from having the world's reserve currency. That means the dollar is the main money nations trust for trade, debt, reserves, and crisis periods. But that privilege comes with a shadow. The world needs dollars most when the world is least healthy. So the stronger the dollar gets during stress, the more it can tighten the very system that depends on it. That can crush weaker currencies. It can force foreign central banks to raise interest rates, even when their own economies are already slowing. An interest rate is the price of borrowing money. When that price rises into weakness, it can break demand, jobs, and credit. Then something strange happens. Trouble abroad starts washing back onto U.S. shores. American companies sell less overseas because their goods become more expensive in foreign markets. Foreign borrowers under pressure buy fewer American products. Global funds sell what they can to raise dollars. And suddenly the strong dollar that looked like strength starts helping create weakness at home. This is why Dalio's warning matters. He studies long cycles, not just headlines. He looks at debt, money, politics, trust, and power all at once. In that kind of view, a rising dollar can be less like a medal on the wall and more like stress in the beams of the house. Take a normal American saver named Linda. She is 63, close to retirement, and she did what she was told for decades. She worked, added to her 401k, kept a little cash, paid down debt slowly, and believed that if she stayed disciplined, the system would meet her halfway. Now she sees prices still high, bond values bruised, stocks more fragile than they look, and the dollar being called strong. At first, that sounds comforting to her. If the dollar is strong, maybe her savings are safe, maybe the country is on solid ground, maybe the storm is happening somewhere else. But if that dollar strength is coming from global stress, tight credit, and a rush into safety, then what Linda is hearing as reassurance may actually be an early alarm. Because retirement is not protected by symbols. It is protected by purchasing power, income stability, and a market system that can carry promises into the future. Purchasing power means what your money can actually buy. A strong dollar can help on imported goods at the margin. But if it arrives with layoffs, market losses, and emergency policy shifts later, the comfort can be short-lived. The same is true for workers who are not near retirement. A strong dollar can lower the cost of some imported products. That sounds helpful. But if it also hurts manufacturing demand, pressures exports, and tightens financial conditions, the trade-off can be brutal. A cheaper television does not mean much if the overtime hours disappear. This is where numbers matter, but only if they stay tied to real life. The world carries trillions of dollars in debt that must be serviced in dollars. The United States carries federal debt so large that interest expense itself has become a serious political and budget problem. And when rates stay high at the same time, the dollar stays strong, both the outer edges and the center begin to feel stress. That combination is easy to miss because the first phase often feels orderly. Markets call it resilience. Politicians call it confidence. Financial television calls it a vote of trust. But early stress usually does not announce itself with broken glass. It announces itself with quiet strain, thinner margins, rising defaults, tighter lending, and fewer easy exits. Ask yourself this: if a currency is rising because the whole world is scrambling to secure it, is that pure strength, or is that a sign the system has become dangerously dependent on one door staying open? If questions like that are why you keep coming back, subscribe and stay with me. The big shifts usually start as small misunderstandings that most people wave away. There is another layer to the trap. A strong dollar also helps hide the damage done by debt for a while. It creates the feeling that trust is intact. It lets markets pretend that high borrowing costs are still manageable because capital is still flowing into dollar assets. But debt problems do not disappear because confidence buys a few more months. They age in the background. They roll forward. They get refinanced at worse terms. Refinancing means replacing old debt with new debt, usually at a new interest rate. When governments, companies, or households must refinance in a more expensive world, the bill shows up later, and later has a way of arriving all at once. This is one reason bond markets matter so much here. A bond is a loan investors make to a government or company. For years, people treated U.S. government bonds as the quiet foundation under everything else. And in many ways, they still are. But when debt levels grow huge and interest costs rise, even the strongest foundation starts to demand more maintenance. Now put yourself in the seat of a central banker outside the United States. Your currency is falling, imported energy is getting more expensive, capital is leaving. If you cut interest rates to support growth, your currency may weaken even more. If you raise rates to defend the currency, you may deepen a slowdown at home. That is not policy freedom. That is policy trapped by the dollar, and the United States has its own trap as well. If the economy slows badly, pressure builds for the Federal Reserve to cut rates and add liquidity. Liquidity means easy access to money and credit. But if rates are cut too soon, inflation can return. If rates stay high too long, debt stress can spread. Either path carries risk. That is why the phrase strong dollar can be misleading. It sounds like a clean victory. In reality, it may mean the system is being pulled in opposite directions at the same time. Confidence in the dollar can rise, while confidence in the long-term debt path falls. Short-term safety can strengthen, while long-term trust quietly erodes. Some viewers will hear all this and say, fine, but if the world still runs to the dollar in trouble, doesn't that prove the dollar wins anyway? It is a fair objection. For now, in many ways, yes. In a panic, the dollar still tends to be the place people run. But that is only half the picture. A fire exit can be essential and still tell you the building has problems. The fact that everyone runs toward dollars in crisis does not mean the global system built around dollar dependence is healthy. It means the system has one dominant shock absorber. And if that shock absorber is used too often, the stress does not vanish, it accumulates. That accumulation is why gold keeps reappearing in the conversation. Not because gold suddenly became modern, not because central bankers became romantic, but because gold is no one else's liability. A liability is something someone owes. In a world full of debt, promises, and political strain, that begins to matter more. You can see the broader shift in behavior. Central banks in many countries have been buying gold in serious size. Nations are talking more openly about settlement systems that reduce dependence on the dollar at the edges. No, that does not mean the dollar disappears tomorrow. It means trust is still present, but no longer taken for granted. If you find it useful to look past the daily price moves and ask who is trying to escape which kind of risk, subscribe here. That question tells you more than most market commentary ever will. Price is only the surface. Pressure underneath it is where the future usually starts. Now let's deal with the biggest comforting thought people hold on to. They say America is still the largest economy, still the deepest capital market, still the military power, still the home of the reserve currency. All true. Those are real strengths. But strong countries can still run into debt limits, political limits, and credibility limits over time. History is full of powers that looked unshakable right before the cost of maintaining the system became too heavy. Not because they became weak overnight, because the math changed slowly while the story stayed the same. Debt piled up, interest costs climbed, politics became more reactive, and the gap between what people expected and what the system could deliver got wider. The dollar trap lives in that gap. A strong dollar keeps the old story alive a bit longer. It makes the center look solid. It makes decision makers feel they still have room. But the more the world leans on the same center during stress, the more fragile the system becomes if confidence ever slips. And confidence rarely breaks in a straight line. It breaks in chapters. First, people stop trusting forecasts. Then they stop trusting policy timelines. Then they stop trusting that inflation will stay contained, or that rates will fall cleanly, or that deficits will be harmless forever. Finally, they stop trusting that the asset which was safe in the last crisis will behave the same way in the next one. That does not mean we wake up tomorrow in monetary chaos. It means the next phase could come in several forms, and investors need to think in paths, not slogans. One path is a controlled slowdown. Growth weakens, inflation cools enough, the Federal Reserve cuts gradually, and the dollar eases without drama. That is the neat version. Another path is rougher. Something breaks in credit, commercial real estate, private lending, sovereign funding, or global banking. The dollar spikes even higher in the panic because everyone wants liquidity, then emergency measures arrive. Rates fall fast, money floods in, and the problem shifts from tightness to currency distrust and sticky inflation later. There is also a third path, and it may be the most realistic, because it is the least theatrical. No giant collapse, no clean reset, just years of slow erosion, higher debt, more political pressure, periodic liquidity scares, a weaker long-term bond market, more support for hard assets, and a dollar that stays dominant but not unquestioned. Which path matters most to normal people? All of them, because each one changes how you should think about safety. In the first path, patience matters. In the second, liquidity matters. In the third, purchasing power matters more than appearances. And in all three, blind trust becomes more expensive. What should a person like Linda or a younger worker or a small business owner take from this? Not panic, not some dramatic all or nothing bet. The lesson is to stop confusing signal with meaning. A strong dollar is a signal. Its meaning depends on what is causing the strength and what that strength is doing to the system around it. If the dollar is strong because productivity is booming, investment is healthy, debt is manageable, and real incomes are rising, that is one story. If the dollar is strong because the rest of the world is strained, because credit is tight, because capital is hiding, and because debt is starting to bite, that is a very different story. The price can look similar. The future behind it is not. So preparation has to be more thoughtful than chasing headlines. People need enough cash or short-term safety to handle shocks. They need to respect debt and avoid being trapped by rising rates. They need to understand that stocks, bonds, cash, and hard assets do not all protect against the same danger. And they need to think about resilience, not just returns. Resilience is not exciting, which is why almost nobody values it until after the hit lands. It means not needing perfect timing. It means not assuming the next decade will behave like the last one. It means being able to survive high rates, sticky inflation, market drawdowns, or a policy reversal without having your life thrown off course. That kind of safety rarely trends on social media, but it ages well. Here is another question worth sitting with. When the world keeps rewarding the dollar during periods of stress, is it confirming long-term trust, or is it simply revealing how few alternatives people can use in the moment? If you want a channel that stays with questions like that, instead of rushing to easy certainty, subscribe and stay near. The most important market truths are often uncomfortable long before they become obvious. Dalio's deeper point is about cycles. Debt builds for a long time because the system seems to handle it. Then the cost of carrying that debt changes. Then politics changes in response. Then money changes in response to politics. By the time people notice the cycle itself, they are usually already living inside its consequences. And those consequences do not stay in research papers. They show up in mortgage rates, job security, insurance costs, pension math, and the tone of everyday life. People become more cautious, employers become more selective, governments become more tempted to promise relief they cannot easily fund. That is when markets stop being abstract and start shaping mood, trust, and behavior across society. You can already feel pieces of that mood. People sense that numbers on screens and life on the ground are telling different stories. They hear that the consumer is strong while their grocery bill says otherwise. They hear that the labor market is solid while hiring gets slower. They hear the dollar is strong while the system around them feels less stable than the label suggests. That tension matters because narratives guide behavior. If people believe strength means safety, they relax when they should be studying the structure. If leaders believe demand for dollars means unlimited room, they borrow when they should be reforming. If investors believe the last rescue playbook will always work, they lean in exactly when flexibility matters more. The trap is not just the dollar. The trap is the story told about the dollar. So where should your eyes go from here? Watch credit spreads, which show how much extra yield risky borrowers must pay over safer debt. Watch bank lending standards. Watch whether foreign economies are defending currencies with painful rate choices. Watch gold, not as a religion, but as a vote on long-term trust. and watch whether bond buyers keep demanding higher compensation for funding big deficits. None of those signals alone gives the full answer, but together they tell you whether dollar strength is healthy confidence or crisis demand. That distinction is everything. One supports a durable future, the other buys time while pressure gathers in the walls. Markets often look calm right before the structure starts talking. If this way of seeing the system helps you hear those warning sounds earlier, subscribe and stay with me, not for noise, for pattern recognition, because once you understand that the strongest looking price can hide the deepest imbalance, you stop reading markets like a scoreboard and start reading them like a map. In the end, the trap is emotional as much as financial. People want reassurance. They want one number they can point to and say, there, we are still fine. The dollar gives them that comfort because it is familiar, powerful, and still central. But comfort and clarity are not the same thing. A rising dollar can absolutely be real strength. It can also be borrowed time wearing a confident face. The task is not to worship the move or deny it. The task is to ask what kind of world produces it, who is being squeezed by it, and what the response will be when the squeeze goes too far. That is the difference between watching markets and understanding them. So yes, the dollar looks strong. That may be true on the screen, in the headlines, and in the first reaction of capital. But if that strength is being powered by debt stress, global shortage, policy constraint, and fear-driven demand, then it is not the end of the story. It is the quiet beginning of the next chapter, and the people who come through that chapter best will not be the ones who confuse strength with safety. They will be the ones who saw the trap inside the shine.